Well, now Morgan Stanley CIO is saying 20% gold. Does that mean gold could still go up 20 times from here? Well, anything's possible, seeing that the proportion of investment assets in the United States now, in terms of gold, is about 1%, and around the world as well. It could be even less. So Morgan Stanley could be the first one to get the ball rolling. Friday, September 19th, 2025, Monaco 64, home of alternative economics and contrarian views. Well, we're going to look at how Wall Street is warming up to gold. Yes, of all institutions, they're calling for more gold allocations. I think it's highly significant. You might be wondering where Clive is. He's usually with me on a Friday. Well, he is attending an investment conference, I assume, in Geneva, Switzerland this morning. So he couldn't make it. But I'm sure he'll probably be on for the live stream on Sunday. We'll see. Before we look at Wall Street, let's go over some headlines and some news that we've seen of recent. One that pertains to the UK came out actually about 20 minutes ago. As I speak here, it's 7:22 a.m. London time. And we had the budget deficit numbers. They're expected to come out at a deficit, unfortunately, of £12.5 billion, but it was almost 50% higher at 18 billion. So it just goes to show they have a really bad problem. Well, the problem, of course, is heavy taxation, heavy government spending, and heavy regulatory regime punishing all businesses, really. And it's not gonna improve, I think, because socialists don't change their spots, or they might change it a bit, but not very quickly. So we'll wait for the November budget. But another reason why, in my opinion, you need to try to keep some of your savings, some of your wealth outside the financial system via something like gold, physical gold, gold sovereigns and gold Britannias. Mainly because it's not part of the financial system. It's harder for them to come after your gold and silver in your possession. And the tax regime is pretty good for now. They're both coins of the realm are capital gains tax exempt in the UK. So the other headline that came out 2 or 3 days ago, and it's still like, I don't see many people talking about it. I had a very good friend of mine who called me. He used to work for one of the major think tanks in London. He covered the Middle East in particular, and he knows what's going on there. And he contacted me yesterday. This is a seismic event. And I agree with him. So what is the event? Well, you can see here the FT reporting. Saudi Arabia signed strategic mutual defense pact with Pakistan. So basically, Israel has pushed Saudi Arabia into this, mainly because they bombed Doha in Qatar, right? A couple of weeks ago. And the Saudis don't trust the Israelis nor the Americans anymore. And why is this seismic? Well, because the whole raison d'etre of the petrodollar was this pact between the United States and Saudi. Saudi Arabia sells its oil in dollars. And the United States defends the kingdom, but that looks like it's out the window. So another chink in the armor of the petrodollar, if not the final nail, actually, in the coffin of the petrodollar, I would say. The other thing I wanted to mention, and this has got to do more with the Treasury market, is that after the Fed cut rates on Wednesday for the first time since December last year, and also kind of announced they're going to cut again this year, the 30-year Treasury yield actually has gone up. So it just goes to show what the Fed does. Yes, they can control the short-term rates, but not the longer-term rates. As I look through my chart here, prior to the Fed's decision, the yield dropped to 460, and we're now this morning at 475. So it's up 15 basis points since then, which is quite significant. Yes, it could be a little bit of a buy the rumor, sell the fact kind of thing. But we need to keep an eye on this. The key level really in the 30-year is 5%. I'm sure Besant is going to keep a close eye on that. But we might not be out of the woods in terms of the bond market. Well, I don't think we are. And that could push the Federal Reserve into yield curve control. But that's still far away. So let's go back to Wall Street warming up to gold. Almost like Maneco 64, right? I've been warmed to gold. Even when I worked in the city of London, I started accumulating a little bit of gold back in '02, and have been trying to do so ever since. And here on this channel, of course, I've been telling you the importance of gold since 2015, when gold was around $1,000 or 750 pounds. And I've shown you this many times, the editorial from the FT back in 2004, which I cut out and laminated. And it says, going gold. The pointlessness of holding bullion continues to sink in. And you can freeze the screen, take a screenshot, and read it. I'm not going to read it, but basically they're saying that gold is finished. It was useless. The central banks had inflation under control. Everything was fine. When I read this editorial back in the day, I was kind of like, at first I was angry, but then I realized this is rubbish. It was my first experience, really, if you want to call it that, with fake news, because I think that's what it was. And why am I showing you this now? Well, because the FT, the Wall Street Journal, they're mouthpieces of Wall Street. And now Wall Street is actually saying, no, gold is, gold is back. So what proof have I got? Well, the first one is to do with the venerable Morgan Stanley, right? Investment bank Morgan Stanley, CIO, favors a 60-20-20 portfolio strategy with gold as inflation hedge. Well, you probably heard of the 60-40 portfolio, 60% stocks, 40% bonds. Well, now Morgan Stanley CIO is saying 20% gold. Does that mean gold could still go up 20 times from here? Well, anything's possible, seeing that the proportion of investment assets in the United States now, in terms of gold, is about 1%, and around the world as well. It could be even less. So Morgan Stanley could be the first one to get the ball rolling. We might see Goldman Sachs, JP Morgan, and others come out with this new 60-20-20 portfolio. So let's quickly go through this article. It's not long, and we'll see why they're warming to gold. A 60-20-20 portfolio strategy that includes 20% gold is more resilient inflation hedge at a time when U.S. equities are offering historically low upside over treasuries and investors are demanding higher yields for long-term bonds. Morgan Stanley Chief Investment Officer Mike Wilson said on Tuesday, a 60-40 portfolio, which typically has 60% of its holdings in stocks and remaining 40% in fixed income, counts on moves in the two asset classes to offset one another, with stocks strengthening amid economic optimism and bonds rising during turbulent times. Wilson, however, favors a 60 allocation to equities and 20 each to fixed income and gold. Within bond markets, the prominent Wall Street bear prefers shorter duration treasuries of 5 years over 10-year notes to capture rolling returns along the yield curve. Yes, he's concerned about the longer durations because they're not performing as well. And you can adjust quicker over 5 years. If rates go up, you can always reinvest quicker, even though 5 years, you might argue, isn't that quick, but it's quicker than 10 years into the higher yields. Gold is now the anti-fragile asset to own rather than treasuries. High-quality equities in gold are the best hedges, Wilson told Reuters Global Markets Forum. The strength of a dual hedge lies in the contrast. Both hedge inflation, but equities are growth-linked, risk-on bets, while gold rallies as a safe haven when real rates fall in downturns. U.S. stocks have rebounded from near bear market levels following President Donald Trump's Liberation Day tariff announcement on April 2nd, and the S&P 500 and NASDAQ composite hitting several new highs in September, a historically weak month for equities. Spot gold prices, meanwhile, surged past $3,700 an ounce to a record high on Tuesday, buoyed by mounting expectations of a rate cut by the Federal Reserve this week. The lows in April will prove to be great for many stocks. The moves we've seen since then in some of the most beaten down areas have already been remarkable, Wilson said. Alpha is making a comeback since Liberation Day, he added. Alpha is the excess return over a benchmark to describe an investment strategy's ability to beat the market. Meanwhile, fund managers warn that treasuries are losing some appeal as skepticism over the Fed's independence is beginning to weigh on long end yields. So it's not just Morgan Stanley warming to gold, it's also the bond king, Jeffrey Gundlach. And recently he spoke, and this is what he said: go overweight gold. Well, and this is a bond guy. And I quote him, I still think gold serves a purpose in portfolios, he said, suggesting allocations as high as 25% of a portfolio may not be excessive. He framed such positioning as an insurance policy rather than a speculative bet, and one that could see even more upside if macro trends hold. He even floated the possibility of gold surpassing $4,000 an ounce by year end, a level that would mark a seismic move in the metals market. For RIAs, the key takeaway is to re-examine client exposure to commodities and gold-related instruments, whether through direct bullion holdings, ETFs, or gold miner equities. So there you go. Yeah, this is huge. The investment managers are going to start looking into gold. They're going to be saying, how come we don't have any gold? And clients, are going to be calling them and saying, how come we're not exposed to gold? And that's why 20 times the gold price from today is not impossible. I'm not saying it's going to happen tomorrow or even next year, but over the next few years, I don't think it's out of the realms of of possibility. Back in the 70s, gold went from 35 to almost 900. That's more than 20-fold. And that was an era where bonds were out of favor. And it looks like bonds are becoming more and more out of favor, even with the Bond King and Morgan Stanley. So let's quickly look at where the markets are this morning. So it's 7:38 a.m. London time. Spot gold is at 36.46. It's only up a couple of dollars. Earlier this morning, I checked out the markets and it was about $10 higher. So it's moving around. Here's just noise. But the technical picture for gold, silver, and the miners still looks pretty good to me. And for some of us, it seems like this bull market has been going for a long time. But for the general public, for Wall Street, I think we could be still in the early innings. So just hold on tight. Be right and sit tight, as Jesse Livermore once said. Spot silver is up 30 cents, almost up 1% at 42.12. High's been 40. Low's been 41.63. The stock market, the Dow futures is down 20. The NASDAQ is unchanged virtually, and so is the S&P. Everything's fairly quiet. The currencies as well are fairly quiet, with the exception of the British pound, which is down about a third of a percent. And not surprising with the bad news about the budget deficit. And it looks like the Bank of England isn't helping out. They didn't cut rates yesterday because our inflation rate, or CPI, that they call inflation CPI, which is wrong, is running at 3.8%. But it's more like 4.8. And I think the Bank of England knows that because they conspired, in my opinion, that's speculation, with the ONS and the government back in 2022 to fudge the CPI numbers. You can watch this video I did here back in 2022. So, what I'm saying is CPI is more like 5%, and the Bank of England knows it. Yeah, the pound, I think, is a little bit like Wile E. Coyote right now. It's looking down, and it's going to drop very quickly soon, in my opinion. And with that, I'm going to wish you all a great weekend. Take care. Bye.